The trading floor was awash in red on April 7, 2025. A wave of selling had gripped the markets, sending shockwaves through the financial world. Wall Street, the supposed barometer of American economic vitality, was in free fall. The catalyst? President Trump's surprise announcement of sweeping new tariffs. This wasn't just another market blip, it was a seismic event that threatened to unravel years of economic growth. The numbers were stark, a testament to the fear that had seized investors. The Dow Jones Industrial Average, a bellwether of the American economy, plummeted over 3%. The S&P 500, a broader measure of the market, fared even worse, shedding over 3.5%. And the tech-heavy NASDAQ Composite, a beacon of innovation and growth, was hammered, falling by a staggering 4%. The markets hadn't witnessed such a dramatic sell-off in years. It was a Black Friday on Wall Street, a day when fear and uncertainty reigned supreme. The question on everyone's mind was simple, yet terrifying. How bad would it get? President Trump, known for his unpredictable pronouncements and penchant for economic brinkmanship, had once again thrown the markets into disarray. His weapon of choice? Tariffs, those blunt instruments of economic warfare that had become a hallmark of his presidency. The president, seemingly unconcerned by the warnings of economists and business leaders, had doubled down on his protectionist agenda. This wasn't just a targeted strike against a specific industry or country. This was a full-blown trade war, with tariffs being levied on a wide range of goods from across the globe. The president argued that these measures were necessary to protect American jobs and industries from unfair foreign competition. He claimed that other countries had been taking advantage of the United States for too long, and that it was time for America to fight back. However, many experts feared that the president's actions would have the opposite effect, harming the very people he claimed to be protecting. Tariffs, they argued, would lead to higher prices for consumers, reduced profits for businesses, and ultimately, job losses. The stock market's reaction to the president's announcement seemed to confirm these fears. The S&P 500, a key indicator of the health of the American stock market, had officially entered bear market territory. This wasn't just a technical term, it was a stark warning sign. A bear market, defined as a drop of 20% or more from a recent peak, signaled a sustained period of decline in the market. Historically, bear markets have been associated with economic recessions, periods of prolonged economic contraction. Data from CFRA research showed a chilling correlation. 9 out of the 12 bear markets since 1948 had coincided with recessions. The prospect of another recession so soon after the last one was a frightening thought for many Americans. The last time the S&P 500 had entered a bear market was in June 2022, a mere 3 years ago. That downturn, triggered by a combination of factors including rising inflation and geopolitical uncertainty, had been painful but relatively short-lived. This time, however, the fear was that the president's actions could prolong the pain, pushing the economy into a deep and protracted recession. Section 4. Investor Flight. Seeking refuge in uncertain times. Investors, faced with the prospect of a prolonged market downturn, reacted in a predictable manner. They headed for the exits. The selling was relentless, driven by a combination of fear and uncertainty. No one wanted to be left holding the bag when the music stopped. As stock prices tumbled, investors sought refuge in safer assets, such as government bonds. The yield on the 10-year Treasury note, a benchmark for borrowing costs, plummeted as investors piled into these perceived safe havens. The flight to safety was a clear indication of the level of fear in the market. Investors were effectively betting against the economy, seeking the relative safety of government bonds over the perceived risk of stocks. This rush to safety had further implications for the economy. Lower bond yields, while good news for borrowers, could potentially stifle economic growth by making it less attractive for businesses to invest and expand. It was a vicious cycle, with fear feeding on itself and threatening to drag the economy down with it. Section 5. Tech Titans Tumble. The Price of Uncertainty. The technology sector, which had been one of the main drivers of the market's bull run in recent years, was hit particularly hard. Apple, the world's most valuable company, saw its stock price plunge by nearly 30% from its recent highs. Nvidia, a leading maker of graphics processing units, suffered an even steeper decline, with its stock plummeting by over 34%. Microsoft, another tech behemoth, wasn't spared either, with its stock price down by 19%. The reasons for the tech sector's woes were multifaceted. Firstly, tech companies with their global supply chains and reliance on international trade were particularly vulnerable to the president's tariffs. Secondly, the prospect of a global economic slowdown, fueled by the trade war, dampened the outlook for tech spending. The decline in tech stocks was a worrying sign for the broader economy. The technology sector, with its innovation and job creation, had been a key engine of economic growth in recent years. A prolonged downturn in the sector could have ripple effects throughout the economy, impacting everything from consumer spending to business investment.